And we have our special guest today. Everybody welcome Sharon Heaton. Sharon, do you want to go ahead and introduce yourself?
Certainly. My name is Sharon Heaton. I am the CEO and founder of SB Liftoff. SB Liftoff is a national M&A advisory firm, which is just a way of saying we help people buy and sell companies. And we have extremely deep expertise in the GovCon market. Our clients typically have between 10 million and 100 million in revenue, and our transactions are generally 50 million and below, which means that we deal with the set-aside market quite extensively, and that's the world in which we live.
Mhm. All right. And yes, as Sharon mentioned, she is the CEO and founder of SB Liftoff. And I heard that you have a fancy little book giveaway if you wanted to speak to that.
I do. Earlier this year, excuse me, I released a book published by Forbes called Liftoff: 12 Things to Know Before Selling Your Company. It's extremely useful for sellers, but it's actually really useful for buyers as well, because it goes through the process and what are the parties thinking about it all steps along the way. I found that in talking to literally hundreds of business owners, I was being asked the same questions. What is the process? What is due diligence? How do you keep this confidential? How are valuations done, etc. So I sat down and I wrote the answers, not without jargon. So it's written for the smart business owner who may not be an expert in M&A, but it is certainly something that you should know about. And we are happy to give a copy of the book to anybody who's interested. So we're giving the name for Kyle DeCamp with SB Liftoff. Please reach out to him, ask for a book, and we'll pop it in the mail to you.
Yeah, that's awesome. Thank you so much for that. Amber, if you could go ahead and put that email in the chat, that'd be great, as well as Sharon's contact info too. And very timely, as I don't know if you guys have seen on LinkedIn, but the Pulse is currently working on a book ourselves. So very
Wonderful.
cool. All right, so I'm going to hand it over to Sharon in just a second, but just if you have any questions, feel free to put them in the chat. Amber and I will be monitoring the Q&A, and we'll either ask them as the questions pop up or save them until the end when we have more of an open discussion format. But all right, Sharon, over to you.
Okay. Well, I'm going to talk a little bit about the M&A process. And the first question is, why should somebody buy a company? And that's what this slide is talking about. Basically, when people come to us and say, I'm in X amount of revenue and I want to be at Y amount of revenue, that's not a great idea to buy a company. Buying a company is not an easy thing to do. So you want to have a really strategic reason why you want to be doing that acquisition. First one, of course, is expand capabilities. Maybe you want to get into cyber, AI, digital migration. Maybe you're already there, but there's a specific skill set that you want to add to that. That is a very reasonable reason. You might be talking to a company that has access to new agencies or vehicles that you want. Well, rather than competing in the process and taking the risk that the government will or will not select your proposal, you could buy a company that has those vehicles or has access to those agencies. Clearly, M&A is very important as you're getting ready to shift into full and open. And that's a conversation in and of itself. But the basic thought is, if you are still in set-aside land and you're going to be sizing out this year, next year, whatever, it's very hard to be successful in the full and open market when you've exceeded your set-aside goals by $1 million. It's often better to do it by sizing out a lot. And we find that people will do acquisitions so they don't simply inch over that 5-year revenue average, but rather they can go with economies of scale significantly bigger. Clearly, you do an acquisition to improve past performance, to attract teaming partners, and then there are just the economies of scale that you can get by being a larger company. So these would be the reasons why people buy. It's important to understand this not only from the buyer side, but as the seller, you want to be thinking about what is it you're offering to a buyer so that you can strategically position yourself to be a desirable acquisition. Let's go to the next slide. GovCon, I'm sure the audience understands this, is very different than the commercial market. Mergers and acquisitions are challenging in any segment. They are even more difficult in government contracting because of the extensive regulations. And there are special rules that come into play that I think are particularly important. When acquiring a federal government contractor, there are some specific risks that you need to be aware of. You need to understand the period of performance for whatever vehicles they have. Um, I've seen people make the mistake of focusing on the total contract value as opposed to the amount of revenue actually to be received. So not uncommon, somebody will come to us and say, we have backlog of $50 million and we've got 4 years left on this vehicle, so we have $50 million of backlog. But when we look at the work that was actually done in the first 2 years, they haven't done $10 million, they've done $1 million. So it might have been a 50 million contract. There's $48 million still left, but the buyer needs to understand it's not really 48. It's probably a continuation of the same $1 million a year. So confusing total contract value with revenue is a significant mistake that buyers can make. Certainly not understanding the size out process. The 5-year revenue average is what applies to most companies. And if companies that's rapidly growing might size out in less than 5 years if they're reaching those 5-year revenue averages. I think everybody who understands GovCon understands the challenges of moving into the full and open market. And people who don't understand GovCon don't seem to understand that that's a fairly big jump. So understanding the challenges of getting to the full and open market. I think it's extremely important when you're looking at companies to figure out where the value is actually coming from. We've certainly seen companies that have a very attractive net margins at the end of the day, 10%, 12%, 14%. But when you look at the gross margin by contract, you can actually see that there's 3 contracts that are loss leaders. And you've got to understand which ones are profitable and which ones are not. And certainly understanding who the selling company has relationships with, that goes back to the strategic issue as to why you're doing the acquisition in the first place. If you're doing it simply to get vehicles, that's great, but it's worth more if that selling company has client intimacy. And then, of course, just another one is the tax implications in a transaction. Most transactions, commercial transactions in the under $100 million market are done as asset sales, so that the buyer is purchasing the assets and picking through the liabilities that they want to absorb. In the GovCon market, there's almost always going to be a stock transaction because that's how those contracts get transferred over. There are significant tax differences between the stock and the asset transaction, and that is something that you really need some sophistication to understand. Haley, I just spoke a lot. Do you have any questions about what it is I've said?
Not so much. I mean, I think if we could just pull on the thread about understanding who in the selling company has relationships with the customers. I think a lot of times in small businesses, that is the founder or the CEO. And Amber has this quote that she says a lot about that 100% of company owners and CEOs will at some point leave their company in one way, shape, or another. So I'm interested to see how particularly that plays out if the CEO is looking to kind of take a step back, but they're the one that has those key relationships.
An excellent question and incredibly important as well. I was talking to a business owner yesterday who has a GovCon company, and all companies basically do 3 things. They bring in work, they do the work, and then they've got the back office responsibilities of insurance and taxes and payroll and HR, et cetera. The buyer can take those over the issue of the back office. But when a buyer is looking at a company, they want to make sure that after they buy it, it still has the first 2 functions, the ability to bring in work and the ability to do the work. If the owner is the only person who's bringing in that work, who has that client intimacy, and people call up because we know Bob, we like Bob a lot. Well, when the buyer buys that company and Bob leaves, how is that company going to get work? It's one of the reasons why we often turn to sellers And while we're M&A people and we love doing transactions, we will tell to sellers, you're not ready to sell yet because you need to convert your company into being a company as opposed to it being a job with staff around to help you do your job. So is that company transferable? And the way to do that is to make sure that work will come to the company, even if, God forbid, the owner were to step out into the parking lot and get struck by lightning, would any customers continue to work with that company? If the answer is no, you've got a job with staff. If the answer is yes, then it's something that a buyer would be interested in. But that is really a very critical point, Haley, and I'm very pleased that you raised it.
Yeah, thank you.
Um, Okay, so there really are two areas to focus on when you're bringing your company to market. The first slide was about why would you buy a company? This one is about what is the timing for a seller to bring their company to market? And there's two things that need to happen. One is that the company needs to be ready to sell. And two is that the owner needs to be ready to sell. And those things really are distinct. We've certainly seen companies that are ready without an owner who's ready. We've seen many owners who are ready with companies that are not. So what does it mean? We talk about this a little bit in chapter 4 of the book. Again, anybody who wants it, please reach out. We're happy to give it to you to make sure that the company, in fact, is transferable. Um, First is financial performance. You can transfer a company that is not doing great. That is, the revenue has been flat, the margins are declining, whatever. You're going to get a better value for a company that's growing. And we'll talk about that in a little bit further. Also, how good are your financials? Virtually every business owner says that their financials are in pretty darn good shape. But we as third parties come in and take a look and say, well, let's talk about that a little bit. They look good to you because you understand how they've set them up, but it's not normal procedure. And we need to be able to make sure that a third party coming in understands what your financials actually mean. And then, of course, particularly in GovCon, high visibility to future cash flows. What that means is, do you have backlog? And what kind of backlog do you have? Do you have project-based backlog, i.e. the government will call you and say, we need a widget, send that to us? Or do you have a contract that has a base year with some option years? Companies with base year and option years tend to get higher valuations than companies that are project-based. The second one is the management team, kind of what you were referring to before. Is the owner essential for day-to-day operations? Again, that existential stepping out into the parking lot and getting hit by lightning. If the company stops when that owner isn't there, then you've got a problem. It's incredibly important to have a strong and scalable management team in place at the time that you're going to market. The buyer is going to assume that no matter how hard the seller says that they're going to work after a transaction, they're going to work less hard for the buyer than they would for themselves. So really understanding what the buyer is going to be looking for is a management team, and that would be something pretty important. Then additional consideration, are you essentially freelancing every time? Do you have a process when you start a new contract? What's the level of customer concentration and contract concentration? Customer concentration in GovCon, hey, the federal government is the customer. There's total concentration, but that's a silly way of looking at it. You might even have all of your work is at VA or all of your work is at CMS. That's a lot of concentration, but are there multiple contracts? Are you in multiple offices of that agency? Or is there one government contracting officer who happens to love your company, but if that government contracting officer will go, it's not clear where the next bit of work is coming from. So that kind of makes a big difference. Then issues like company attrition and the transferability of the contracts. So 8As are really quite challenging in this regard. So when I say that SB Liftoff works with set-aside companies, we're working with SDVOSBs, small business, women-owned, minority-owned. 8A is a unique challenge and has to be considered separately. But the company is not the only factor. It's one is the owner ready to sell. Are they ready to have other people take over? My experience has been that business owners, particularly those that are founders, are a bit of a control freak. And it's hard for them to let go and to recognize that however they led the company, the buyer might lead it differently. And that's okay. But that letting go is very challenging. Others are concerned about what are they going to do? They're used to going to the country club and putting on a name tag, having their name in the name of the company. What are they going to do? Who are they when they no longer own the company? Now, there's lots of answers to that. I'm not going to bore people with it right now, but if you've created a company, you've done something pretty darn significant. So figuring out what you're going to do with your time is, there's a lot that you can still be contributing. In addition, many buyers would want some level of involvement with the prior seller. And then making sure that your personal stuff is lined up. I was working with one company that was a C Corp. And I turned to them before we went to market and I said, hey, listen, you're a C Corp, you're subject to double taxation. Would you like to convert to an S before we go to market? And he said, no, 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 all the big guys are C Corps. That's what I want to do. And we went to market, we got a letter of intent, and he said, okay, what can I do about tax planning? And I said, well, we can create a time machine and go backwards, but now that we've signed the LOI, there's really not a lot of tax planning you can do at this point. So all of that kind of retirement, estate planning, really needs to be done prior to an LOI and preferably prior to beginning a process. So there's things that need to be done for the company to be ready and things for the owner to be as well. Have any questions come on that we should be talking about? Okay.
Let me see. Yeah.
Yeah,
think we're
Haley, I'm
good.
happy to lob them out there.
Okay,
So we
thank
definitely
you.
we have 3 questions right now, so we can kind of take a pause and address them.
Yes, please.
So the first comes from Lynn, and her question is, if a small business has mostly small business set-aside contracts, is their likely buyer pool only other smalls? And the second part of her question is, can the relationships and past performance be enough?
The answer to that is yes. SB Liftoff makes its business by selling companies that have set aside contracts. As I said before, not all set asides because 8As are particularly problematic. But if you've got a small business, women owned, SDVOSB, those companies are absolutely sellable. The market for them will be more limited than there would be in the commercial market. So I was at a meeting recently where people were saying they've got companies with 2 million, 3 million, 4 million in EBITDA. These were M&A advisors, and they're sending out the teasers and other marketing materials to 400, 500 companies. Well, that's great in the commercial market. But in the GovCon market, if you're in the set-aside world, we're looking at 20 or 40 people that we're reaching out to. It's a much more limited market. One, you should probably only be selling to people who know GovCon or really want to get into it. And two, you've got to fit somebody who's going to fit into those set-aside categories. Now, there is a lot of nuance on that. Sometimes we'll sell a women-owned company to somebody who's not a woman, but maybe they're a minority. So they can change the set-aside designation and that would work. But yes, it's a very big deal to have these set-aside contracts and the market of buyers is smaller. And what they're really looking for is the amount of backlog, customer intimacy, and those kinds of issues. So they're absolutely sellable in most, well, not all circumstances, and that's what we do. The second question is about the new proposed SBA rules. Those are a big deal, very big deal. Personally, the fact that they put out 200 pages of proposed regulations at the end of August and asked for comments on October 7th strikes me as unfair. Most small business owners I know are pretty darn busy in September. And the idea of absorbing these rules and really focusing on that was not, I thought, a fair timing of that. There's a lot of pushback on it. We don't know if those rules will be adopted or in what form, but they will have a very significant negative impact on the GovCon market. And we could talk about that in greater detail. So then there's another question about the S Corp as the proposed type of corporation to sell. Well, that's a little bit of a simplification. It is a C Corp has double layer of taxation. You get taxed at the corporate level, and then you get taxed again when it goes to the owners, where in S Corp, you only get taxed once. That's great. But the tax rate for C Corps has now been lowered as a result of the 2017 Tax Act. And there are certain preferences available for C Corps that are not available for S Corps, like something called a Section 1202. And a Section 1202 basically says if you have a C Corp and it complies with all sorts of things, don't assume that it's going to apply to every company. It does not. But there are certain special C Corps that if you comply with these rules, you can actually get the first $10 million per owner free of capital gains taxes. So if you grow a company that's a C Corp and meets all of these requirements, and you sell that company for $30 million, there will be no capital gains taxes. Now, again, not all C Corps will comply with these rules. Not everybody sells for $30 million. Not everybody has 3 owners. But hey, listen, I've done a lot of deals where if the one owner could get $10 million of a purchase price with no capital gains taxes, that would be pretty fantastic. So I don't want to say that it's always the right thing to be a C Corp versus an S. There are a fair number of complications between the two. It is relevant when there is a stock sale, but we'll talk about that in a few minutes. Are there any other questions that we should be talking about at this moment, Haley?
I don't have the chat up. Amber?
So you just, and I know we just had another question come through, which let's finish through this, the slides, and we can get to the next one from, that has just come through. And then there's another question in the actual Q&A that I believe you kind of already answered, Sharon, which is how is a company intimacy shown if you're selling? How do you look for it if buying?
You can tell a lot by how the seller talks about their business development process. If they are basically waiting for things to come out from the federal government showing up on SAMS.gov and saying, well, we're looking at SAMS.gov all the time, and when proposals come out, we then start writing to them. That's not a client with a lot of intimacy. That's not a company with a lot of client intimacy. Client intimacy would be, they have a relationship with their contracting officer, with their the government agency that oversees the program, and understands what the concerns are and what are the new things coming out, and having to shape those proposals. So a lot of it is going to come out by understanding the process that the selling company goes through in business development. Are they there during the time that there's kind of a market analysis? Are they talking to the government about what vehicles they themselves have so the government can put it out on those vehicles? So that kind of customer intimacy is what I'm referring to.
That's great. Thank you.
Now, let me go to that last question. What are your thoughts about rollovers as business startups? I have to say, ROBS is a new term to me. So that
I was going to say, I've never heard of a ROB.
I have to say, I want to fess up. I'm not familiar. Here's what 2 things that might be relevant to this. One is, and if we could go 2 slides forward. Keep going, another one. One more. There we go. Nope, one more back. There we go. This is the Cinderella slide. It's kind of how do sellers get paid? It's unlike selling your house. When you sell your house, the buyer comes in, gives you the full price, you pay off your mortgage if you have one, and the money is yours. When you're selling the company, you almost never get 100% of the purchase price at close. It happens occasionally, but not frequently. So there's cash at close. That's great. What are the other things that the seller might get? One is seller financing. That is kind of an IOU. The buyer's buying the company for 10 million, they give you 8, and they're going to pay you another $2 million over time. That's the seller financing. 2 is rollover retained equity. And that's what I'm wondering whether or not that's what this rollover is talking about. Basically, you don't have to sell 100% of your company. Very often, buyers will want the seller to have 10%, 20%, 30% of the company. So there's equity rollover. And then the last is the earnout, the dreaded earnout. But there are ways of structuring earnouts that make a lot of sense. The other is that there are roll-ups where a buyer will come in and say, here are 5 companies that are doing similar kinds of work. And we think that rather than owning just one of them, we would like to buy multiple of those companies. Here's an example outside GovCon. It used to be that HVAC, heating, ventilation, air conditioning companies were pretty much 2 guys in a truck. And over the last 15 years, private equity has come in and said, my gosh, we can get economies of scale. So a huge number of these HVAC companies have been acquired, and so much those 2 guys in a truck no longer own the company, but they're working for a larger one. I'm now looking at the definition that was sent here. Is an arrangement where prospective business owners use their retirement funds to pay for new business startup costs. Okay. This is usually a you've got some type of defined, or I'm sorry, directed investment plan for your 401k. So you might have a 401k with your company, and they're going to say you have to invest in these fidelity things. You definitely can do some using of retirement funds for a startup company. There are a lot of compliance issues associated with that. I don't want to tell you anybody that I'm an expert in it, but this is one way to get access to capital to start your business. Let's hope that Ishita, that was helpful. Okay, let's go back to the slide. Yes, there are 2 slides that we're about to talk about, because one of the things that people ask about a lot is, what's the process? And the process is similar for buying and selling, but slightly different, which is why there's 2 slides included here. This is the one for buying a business. And the first thing that you need to do is prepare. And it is, what do you want to buy? Why do you want to buy it? Do you have the capital? Where's the capital coming from? How much can you afford to buy? Do you want to buy a $5 million purchase price company? Do you want to buy a $25 million purchase price company? What is going to be the impact of that? Are you yourself a set-aside company, and you've got to acquire something that's not going to blow your set-aside standards? And then you've got to do a real assessment. Are you buttoned down enough that you could add another company into your mix and really be able to manage that pretty well? So preparation, it's one of those classics, know thyself. Know what you're doing, why you're doing it, what you're trying to accomplish. Otherwise, it becomes an extremely time-consuming process and very frustrating. Identifying targets. Once you know what you can afford, where the money's coming from, what you're looking for, you got to go find a company. So, how are you going to do that? You're going to talk to folks like us. You're going to talk to your commercial banker, colleagues, conferences. I've got to tell you right now, there's a lot of buyers out there, but a lot of buyers are looking for the purple unicorn that flies. They want to find the $10 million revenue company that has no set-aside contracts with 20% margins and a huge amount of backlog. Well, that would be a fantastic company, but doesn't really exist. In addition, there's a huge value difference between a company that has set-aside contracts and one that has full and open. So if you've got set-aside contracts, your valuation is going to be lower than if you've got full and open. Or put more positively, if you're in full and open land, you're going to be more valuable than a company that has the same contracts but are in set-aside. So there's a lot of understanding of both your own company and the target that you're looking at to make sure it's going to work. There's a huge amount of work that is necessary in this phase 2. including due diligence. We work at SB Liftoff primarily on the sell side. We will not allow a buyer to sign an LOI with us if the buyer has not done a good amount of due diligence. We will not go under LOI and provide exclusivity unless the buyer knows what the heck it is they're doing. There's a lot of buyers that will say, oh, just go under LOI and then I'll figure out if I really want to buy this company. It's not good for the buyer. It's not good for the seller. So really understanding that by the time you're going to the LOI, you know enough about that company that you want to move forward. Third phase is LOI to closing. And LOI to closing is generally, 90 days, could be, 30 days more or less, assuming that there's nothing big that happens that changes it. There really are two separate transactions that the buyer is working on. The first, of course, is the buyer is buying the seller. They have to negotiate that and keep the relationship good. But the buyer is almost always having another transaction with their financing source, hopefully just debt, but sometimes debt and equity. So the seller needs to understand that there's two different sets of things going on for the buyer, where for the seller, they're primarily focused on the one transaction. And then there's a lot of work that gets from that LOI to closing. We could do a much deeper dive in that, but let's move on. Let's go to the next slide. And this is the flip side. This is if you're selling a company. Interesting, it's kind of similar in that phase one is preparation. Now we say phase one is 30 to 45 days, and that's for a company that's pretty well organized. People have asked me, how long does phase one take? And I say, hate this answer, it depends. If I ask somebody for their backlog and they send me a wonderful Excel sheet with a period of performance and what's been going on, et cetera, that's one thing. If somebody says, oh, my backlog, let me take a picture of my whiteboard and I'll send that to you, that company is going to take longer. So a lot of it is how prepared is the seller to go to market. And these are all the things that are happening before you actually even talk to potential buyers. Phase two is the dating stage. You're trying to find the right buyer for your company. Sometimes you meet Prince Charming on the first date and it's great. Sometimes you have to kiss a bunch of frogs. So this is the stage where there's the least control over the timing. It's kind of like saying, how long will it take to date to find my spouse? Well, I don't know. And then again, the LOI to closing period of time. The important thing for the seller is that the signing of that LOI gives the buyer exclusivity. These LOIs are not binding except for the fact that the seller cannot continue to market their company after they've signed an LOI. First of all, it's bad taste. Second of all, there's usually significant penalties in the LOI. So you really want to make sure that you sign an LOI with a buyer that you want to close with. Let's see. Okay. There's a question here about thoughts on 7A loans and limits on earnouts. Well, it's a little bit of form over substance. 7A loans are loans that are guaranteed by the Small Business Administration. They are not loans from the government. They are definitely loans from a bank. And the bank is the one making the loan, but the SBA is saying, if there's a loss, we'll cover 75% of it. So the bank is still on the hook for some of it. The banks have to follow the SBA rules and then get to put their own rules on top of it. So every bank has their own set of SBA rules. And you really want to know what the rules are for that bank. Another factor is that there are preferred SBA lenders and ones that are not. And a preferred SBA lender is one that the SBA has deemed knowledgeable enough about the program that the SBA does not need to redo the underwriting. And that is a very big deal because otherwise you as the buyer are trying to negotiate with the bank and then you got to go to the SBA as well. And that's incredibly frustrating. So working with a preferred SBA lender is pretty darn important. As for the limits on earnouts, it is true that there is a limit on earnouts. However, there's a way of structuring around that. And it's been fairly well established at this point that there are ways to do that with, it's not contingent, but there's a clawback. I can discuss that in much greater detail for somebody who's interested, but we're able to structure SBA loans that have both seller financing, equity rollover, and some revenue shares or things like that. Please elaborate on the search process. How do you identify small targets in GovCon? Well, that is a huge question. It kind of depends upon what it is you're trying to do. Let's assume that you're a buyer and you want to find a seller to buy. Well, look at SAMS. Look at Bloomberg.gov. Look at, HireGov, GovWin. These are all sources, and you can say, I want a company that has XYZ contract, and look to see who has those contracts. Now, many of those companies, generally over 90%, are not interested in selling. So, SB Liftoff has a business where we identify those kinds of companies. But, it's interesting. I was at a meeting recently, and of M&A advisors, and most of them said they prefer working on the sell side than the buy side. And I asked why. And they said, well, sellers generally want to sell, and buyers are often looking to shop. So it's going to be harder to get an advisor to help you on the buy side until you've got some real clarification as to what you're looking for. And then the search process has many different aspects to it, and it's just a huge amount of data research and networking. So any other questions, or should we move on?
I have a question, if you don't mind. First, I love at the bottom how you have to continue focusing on running your company. Like, in the midst of all this, you're still doing your own business, right? But my question was actually about NDAs and the importance of not giving too much away, and like, what are some best practices when doing that?
Well, it's very interesting, and a little push for why M&A advisors are helpful. When we're working on a transaction and we have, company X that we're trying to sell, we will send out a teaser, and it doesn't identify company X. Then a buyer will pick up their hand and say, hey, I'd like to learn more about that. We send them an NDA, and it says, Project Vanilla. You're going to sign an NDA about Project Vanilla. You're signing it with our firm, SB Liftoff. And then only after the NDA has been signed do we reveal the name of the party. If in fact you're trying to sell your company yourself, the moment that you pick up the phone or talk to somebody, it then becomes very clear that your company's for sale. And it's much better to be able to keep that confidential than it is to kind of shout that to the street. I had one client, actually they ended up not being a client, who said that, let me just step back. She was a brilliant woman. She was a graduate of MIT. She had degrees that I couldn't even imagine what those things mean. But she didn't like the idea of working with advisors and said, I'm just going to handle this myself. So she picked up the phone and called 2 or 3 of her competitors and said, are you interested in buying my company? Well, that didn't really work out very well for her. First of all, most of them were, but they put in offers that were truly awful. They also started telling the clients of this company, hey, they're looking to sell. You might not want to give them any more contracts because who knows who the owner's going to be. And then they started rating the employees. So she lost about a third of her staff. So it's really very important to maintain confidentiality. Hey, listen, NDAs are important. They make a big difference, but the biggest difference is the character of the people that you're dealing with. If you've got somebody who is going to blab around, then you need to make specific statements to that person about why they're not going to do that, and then determine whether or not you want to share information with them. There are definitely people out there who are pretend buyers. Oh, heck, let me sign an NDA, what the hell? And now I know all sorts of information about a competitor of mine. So you've got to be very careful on that confidentiality.
That's really great advice. Thank you so much.
Okay.
think we already talked about this one if you wanted to skip ahead.
We talked about this one. These are the 4 ways you get
Mhm.
paid. And I think that that's important for people to understand. And that earnout, which has a terrible reputation, because it's been done stupidly. It's been done so, hey, the selling company has 12% margins. If the selling company continues to have 12% margins, we'll pay you more money in years 1, 2, and 3. Well, that is a loser's game, because after the transaction, margins are based on revenue minus expenses. The buyer is now 100% in control of what those expenses are. They just need to hire 2 or 3 expensive people, and that earnout is blown. So that's a loser's game for a seller and adds to all sorts of disputes between the parties. We will only do earnouts on things that are kind of binary, saying, okay, we're saying that we're going to be growing. And we were 17 million last year, 20 million this year, and we think we're going to be $23 million next year. But the buyer doesn't really know that. You can say, okay, we will give you a small percentage of the revenue for anything over $20 million, and you'll get a revenue share. Well, that's objective. No buyer is going to turn down revenue where they're going to be getting 97, 98% of it to avoid paying the earnout to the seller. So you need to structure these earnouts or revenue shares in a way that's a win-win for the buyer and the seller. But with that, let's move on. Okay, this is an important slide because it's very important for sellers to understand that, and buyers as well. From a seller's perspective, the purchase price is not what you get to put in your pocket. And so here are some of the things that you on the seller need to understand you're going to spend some money on. Lawyers. There are definitely going to be legal fees. And those legal fees will vary a lot on the complexity of the deal, as well as what law firm you hire. There are wonderful, wonderful firms that are pretty expensive. And then there's firms of people who are really quite good, and I refer to as refugees from the big firms. So they have the same skill set, but they're at a very different billable rate. So legal fees is an important component, and it can spread, can be very varied depending upon the transaction. There'll usually be some accounting fees, and we can talk about what that is if people are interested. M&A advisory, we think that's pretty important. One of the things that we really pride ourselves on is that our clients get more value from the work that we do than the cost that they're paying us. So that is, we should pay for ourselves, and we do. Equality of earnings is something that is generally done by the buyer, and there's increasing discussion about sellers doing quality of earnings. What equality of earnings is kind of a deep dive into the last 12 months of financials to see, is there anything weird going on that would make a difference in the future? So for instance, you have $3 million of EBITDA, and $1 million of that is coming from one particular contract that, oh, by the way, is going to expire 6 months after the transaction. The quality of earnings would discover that. Maybe the earnings are $3 million, but there's been a sale of an asset for $1.5 million. That's not going to be recurring. So the quality of earnings is really for the buyer to check out whether or not those financials make sense and whether it can rely upon them. D&O tail insurance. I only raise this because it's not a huge expense, but it tends to come at the very end of the transaction. And by the end of the transaction, there is definitely something called deal fatigue. And deal fatigue is both parties have been negotiating and giving things that feel like they're giving too much. And then I turn to the seller and say, oh, by the way, you're going to need to buy some insurance to make sure that you're protected for any liabilities that occurred prior to the deal, but we don't actually know until after. And sellers will sometimes at that point lose their mind. But if it's worked in the beginning and they know that it's coming, it's a lot better. Additional contingency, heck, I don't know what it's going to be. But one of the things that often comes up are PTO. We've seen some companies that have unfunded PTO accounts that could be 500,000. They've been allowing employees to roll over 2 weeks, 4 weeks of vacation on an annual basis for a long time. And that's going to be a cost of the seller, not the buyer. So, we look for those things up front. Tax elections, we talked about, reorganization, some additional legal things. The buyer obviously is going to have some legal fees. I don't know why that's grayed out. The buyer will definitely have legal fees, accounting fees. Usually at this part of the market, there's one M&A advisory firm. Buyer and seller don't each have one, although you could. The buyer is generally the one that pays for the quality of earnings. The buyer does not pay for the tail insurance, and then whatever contingencies are coming up. So these are things that need to be brought in. And one of the things that SB Liftoff does for our clients is what we refer to as a net proceeds walk. Okay, you've got a purchase price of $15 million. What does that really mean? By the time that you pay these fees and you pay your taxes, you're going to be putting $11.5 million into your pocket. I'm just making these numbers up. So it's really understanding that the purchase price is not what is going to be in your pocket. And for the buyer, the purchase price is not the only amount of money that they're going to spend. They're going to have transaction costs on top of that. So they need to have the purchase price plus. Okay, let's see. Can you talk? So I'm going to go to the questions for a moment. Can you talk specifics on what costs are associated with SB helping buyers identify and buy a company and the cost of the transaction? It is more complicated on the buy side than on the sell side. So that is something that I'd be happy to talk about, but it would be offline. We try and provide those services a bit more on an a la carte basis than on a sell side when it really is a soup to nuts. But, we could definitely talk about that. And yes, there's a question of can we get the deck? We are happy to, have this deck, provide this deck to people who are interested. We do ask that you keep it a little confidential because it is our intellectual property. But, SB Liftoff is very big on education. And the more that you know and understand, the more control you can have over this process. And we think that's pretty darn important. This slide that's in front of us right now, and there's only two more slides that I really want to go on to. This is the primary means by which companies are valued in the GovCon space. And you've probably heard about an EBITDA multiple. Well, what the heck does that mean? There are two important aspects of doing a valuation on this market-based approach or a valuation multiple. The first is taking the net income, turning that into EBITDA, earnings before interest, taxes, depreciation, amortization, and then doing adjusted EBITDA. And we can talk about that for a half hour, but that's kind of the science part of the transaction, getting to that adjusted EBITDA number. The art is figuring out what is the appropriate multiple. So let's say that we have an adjusted EBITDA of 2 and we give a multiple of 3, that company is worth $6 million. That's great. But if we give that company a multiple of 6, that's now $12 million on the same 2 million of EBITDA. So what makes it a 6 versus a 3? That is where a huge number of factors come into play. So here we're saying robust backlog, profit margins, sustained growth, pipeline of new opportunities, diversity of customer base and contracts, whether or not they're set asides, what kind they are they prime versus sub? And to make that a little bit easier, let's go to the next slide. We have basically charted that out to say, hey, listen, if you've got what's going on the left-hand side, it's going to be a lower multiple than if you're doing things on the right-hand side. Unfortunately, one of the unfairnesses of the world is smaller companies get smaller EBITDAs. So companies that are, 5 million are likely to get a smaller multiple than a company that's 50 million. In fact, than a company that's 15 million. So that's one factor. Second is what's going on financially. Are things flat or declining? It's going to get a lower multiple than somebody who's been growing. Backlog. A GovCon company is simply a portfolio of its contracts. And if you have less than 2 years of revenue, and what we mean by that is look at your trailing 12 months of revenue. Let's say it's been $15 million. If you've got less than $30 million in backlog, it's not so great. If you've got over $30 million in backlog, that's pretty okay. If you've got 45 million, that's fantastic. So looking at that backlog. Next is sub versus prime. Are they set aside or full and open? Do you have a lot of client and contract concentration? What kind of work are you doing? Are you doing, pulling wires through the wall, or are you doing high-end cybersecurity work? Do you have security clearances or not? Do you have vehicles, or do you only have straight contract wins? Do you have IDIQs, GWACs, BPAs, et cetera? And then, of course, if you've got best-in-class vehicles, that's even better. And internally, how much of that, how strong is your BD team? Because again, you got to be able to bring in the work. If the work is only coming in because of one owner, well, that's much less valuable than if you've got in-house people who know how to work the system and are able to land work. With that, I've basically finished my slides and would love to go back to questions, or Haley, anything that you might have.
Sure, yeah. Sharon, I want to be respectful of your time. So if you wanted to pick one or two more questions, feel free to go for it. Amber, if there's any standouts, but if not, then we could go ahead and wrap up.
I was gonna say,
Yeah.
I definitely want to be respectful, and I think the questions that we have are great follow-ups for you, Sharon, on the front of kind of getting more in depth and detailed. And we want to thank you so much for your time and sharing all of your knowledge. For everyone that is in attendance, we wanted to let you know that there will be an email going out tomorrow, letting you know Sharon's contact information, another reminder about the free book, and how you can get that, and any other information on any other upcoming opportunities or events that the Pulse has for the remaining of this year. But Sharon, again, thank you so much for coming and joining us for lunch today, and for all of your time. And we will talk to everyone soon. And Haley, I'll let you wrap it up.